Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. Well, the banks all came out this week. Well, a lot of banks have announced over the last 2 days. JP Morgan, Goldman Sachs, Wells Fargo. Wells Fargo was the dark horse in the scenario. Everybody else had pretty good numbers. Now, the marketplace has taken the opportunity to sell them off. I was a little worried about that. We did go long quite a few bank positions. I did really like Goldman Sachs, just the way the chart was and everything that went with it. But Goldman Sachs had across the board real good numbers, forecasting, talking about exactly what I mentioned on the show yesterday, that things are loosening up, mergers and acquisitions. Same scenario with Morgan Stanley. Morgan Stanley had much the same to say about mergers and acquisitions and the freeing up of markets. But all the stocks have taken this as an opportunity to sell off. Goldman Sachs was up right after the earnings report because it was so strong. And now we're seeing it's down $3.31. So I want to start by I like to do this around earnings where you give the stock room to run. Well, I mean, I don't like to be wrong. In other words, we were bullish on it. I would like Goldman Sachs to go up. We would have loved that scenario. But right now, Goldman Sachs is trading right around 700. If anything, I see this as an opportunity to maybe buy some of the financials. I still think that the yield curve is going to start favoring the banks. Even if we do get lowering rates, I still think that we're going to have some situations where the longer term option contracts are going to kind of stay where they're at as far as interest rates, and we see the shorter term come down if we lower rates. I still think there's uncertainty in the marketplace, and I still think that there's going to be longer term issues with rates just in general. So I like the way the yield curve is going. This is everything that I kind of said. We want to do a hedge fund around bank earnings. All of them came out great. But the problem in hindsight, and actually in foresight when I was talking about these trades, was that the stocks have just made too strong of a run since the beginning of the year. Goldman Sachs, JP Morgan, they both sold off a little bit, and I thought that might be the opportunity because they did come off of their highs heading into their earnings. But it looks like investors have taken this opportunity to take a little bit more off the table. Not a lot. I mean, Goldman Sachs, you're talking about $2.85 on this trade. That's not a big deal. It's just annoying to me that it went down. So here's how I'm going to handle that. We went out purposely to the August 1st expiration, which was 16 days away. And that was because this wasn't just an earnings play. In other words, I do think that people will figure it out and take this as a buying opportunity, the fact that the stock is beaten up a little bit. And I do foresee over the short term, especially stocks like Goldman Sachs, JP Morgan on top of it too, even though that's much higher valuation as far as if you look at PE numbers and stuff like that. Also price to book too, I think they're a little bit higher. Morgan Stanley is definitely a little bit higher on the book basis, and that's how we like to look at financials a lot. But here's what my adjustment will be. Okay, I think I don't need to beat the dead horse. So August 8th is our expiration. We bought the 705. Stock was right around, well, it was just about, it was 710 when we looked to put the position on. It was trading close to $15. So we're going to use this August 16th expiration. Let's put this on and let's see how much we're down on the position. So we have the 705 we bought on the ask, and the 740 is what we sold on this. So we are down $5 on the position. Now, oh, nope, even a little bit more. Dang it. Because we sold the 740, 80 cents more. Because we got to buy that back. Okay, so we're all, not bad. We're at 11. We're down. It's $11 right now at the midpoint. So we're down $4 on the trade. So I like to set up if I'm bullish, which I was 100% bullish, if you listen to the last couple of shows on banks earnings and all this, and the earnings were great. The market just decided to sell it off. Oh, now we're back to even. Doggone it. Would you guys stop doing this just because I'm talking about a stock? I want to roll this position and I want to adapt. I want to adjust this position. And the market is now deciding that the earnings are good, and Goldman Sachs is literally up 40 cents. That is just nuts. Is everybody watching Options Guide TV or something? I don't know. There must be a couple million people watching this, I guess. So stocks at 707. Now it's 702.64. We're the 705. This position's at 1140. God, it just jumped 40 cents. But here's my adjustment. I like to go wide on the initial going into the earnings report, saying that if they blow the numbers out of the water, we're giving our stock a lot of room to run to the upside. The downside of doing a spread is that you are selling an option contract on the call side of things that wants the market to go down, right? So you need time decay or implied volatility to come out of that option contract. And that has. So we got the volatility crunch on the 740s. They've greatly shrunk in price. Now we're going to come back and we don't see as much upside because we don't have that earnings catalyst. So what can we do to offset our risk and still give us some upside? We're going to stay in the 705 call option. We're not changing that at all. But now that I don't think the catalyst is there to drive the stock more than a one standard deviation move or to the higher end of the expected move before that earnings report, let's roll this option contract down and lower our risk. But I'm still bullish on Goldman Sachs. So that's part of the reason why I like to go so wide. You capture some of that implied volatility, flush out, give yourself the stock to run. Hopefully you're right. And if not, then you adjust and say, okay, I don't want the cheese anymore. Just let me out of the trap. I don't need to get 740 on Goldman Sachs, which I'm highlighting right now, right? Yep, 740. I'll take 730 or maybe 725. Getting a big juice bump up from 730 to 725. That's right now, the delta's at 31. So you're saying a 31% chance that the stock could get there if the market does go up over the next 16 days. So here's going to be our adjustment. We put the trade on. We had $15 worth of risk. We are down, and that's still going. 1162. Maybe if I talk enough, maybe we'll be back to even on the trade. But no, we're at 1162. We're going to get rid of this. Now, don't forget, we got the 705. We're going to get rid of it. We're going to take this. This will be a buy to close, but I'm going to have to click open because it's a fake account. The position's not in here. 740. We're going to buy to close that, and we're going to roll down, I think, to the 725s. I don't even mind the 720s. You're bringing in $9 there. That delta is 35, but you're not giving yourself a lot of room to run. 15 points. I'm going to do 725. That's how I would make the adjustment if that position was on exactly in my account. So here we go. We're going to buy this. We're going to sell that because I am still bullish on. I'm longer term bullish. Worried about September and October as always. That's the tariffs are kind of creeping into the scenario. Saw some of the data in inflation. Some people are saying it's not happening. Some people saying that it is. But I still think September and October, if we are going to have a downturn, that's when it would be. I do want to get long some VIX going into those months. But here we are right now. We're going to buy the 740 to close, sell the 725 to open. Midpoint net credit is $3.50. So that almost gets us back to break even on the trade. Well, Jake is just saying, where do you think Goldman Sachs Goldman Sachs will hit? Jake, I think if we look at the chart on Goldman, what's really big is that we just set new highs. That's what we want to see, right? So I liked the fact now see, this was parabolic. 1, 2, 3, 4, 5 white candles, 5 up days, kind of petered out right up here at 725, came back down, and now here we are down a little bit today. So obviously this is, if you're just looking at anybody that does charting, is this recent high right here, right at about 725. There it is. I can't see the top of it. Yeah, it's about 725. Right at 725. If we can get back to that range, that would be wonderful. And I hope that over the next couple of weeks that we can. Now, if it breaks through, I wouldn't even mind buying calls in that short-term trade, getting bullish on it. Implied volatility will be off because we'll be through that earnings season at that point in time. But this would be the high end of the range that I would expect in the short term, which isn't a huge percentage on a $700 stock. But with that said, I think this would be my target level, and then I would reassess right at the 725 level. Let me zoom down. Top of that candle is 725.70. 725.70 right there. Okay, so let's go back. So why wouldn't we, and that even kind of fits in right here with what and now there's even more reason to sell the 725 instead of the 720. That's where the recent high was at. It makes even more sense to do this one now in my mind. Doggone it, it's already moved. 290, it was just 350. Gosh, now it's down 4. Well, I hope you hit send in a hurry. Let's call it $3. Okay, so total cost of the trade when we put it in was $15. When we started the show, that spread was trading close to $11. We are now trying to offset our risk. And I don't even mind doing this again next week if you have to, right? If time is decaying and you don't want to necessarily get out of the trade, just keep rolling down the short option contract and keep capturing that time decay. Because if the market's not moving towards that short strike, well, then that option contract is decaying, and it's going to decay very rapidly over the next 16 days. Now, with 7 days remaining on this position, so we go all the way down to the point where 7 days are remaining, it might not be worth reselling or readjusting. You may just want to capture any time value that's left in the long call option. But I'm not going to just leave you hanging, right? We put the position on wide. So when that vol premium came out of that longer, or that 740 call option, we would have the potential to do this trade. So if I had this position on 100% the way that it was all set up, this is how I would adjust the trade. I would buy to close the 740, sell to open the 725, knowing that I have the 705 in, and I still got 20 points from 705 to 725 upside, and I've taken another $3 of risk off the table. Now, we can do that on the other positions. I mean, I think out of all of the reports, we talked about Citi being bad for so long, but once again, the chart's been parabolic. They knocked it. They probably had the best earnings report out of all the companies, including Bank of America, which we also looked at a trade in Bank of America, but that's down 2%. Bank is down. Let's see what Citi's down total. Yeah, 2%. What else do we have in here? Goldman Sachs is down almost 1% at this point, 0.79 of 8.80 of a percent. 0.8%. Schwab is down 1.2%. So they're taking opportunities to sell off the banks. The XLF is not bad. XLF is down 0.33%. So the ETF that tracks the financials, and JP Morgan isn't showing up. Oh, that's because it's got the quote in it. See where JP Morgan is at. And we got Morgan Stanley. Okay, that's 1%. And Morgan Stanley is down 4%. Man, that one really got beat up. But here's one of the things about Morgan Stanley. that was a little bit scarier is it didn't really sell off, right? We came into the marketplace. We didn't really have from these highs the parabolic move up since the beginning of the year, and we didn't really get the sell off. So Morgan Stanley got taken out to the woodshed a little bit harder than Goldman Sachs and JP Morgan in that industry. So if you have any of these positions, if you put anything on that we talked about, adjust them. Take the call option, pull it off the table. Let's see what we did on Citibank. Let's see where that one is at. On Citigroup is what I should say. Pulling that one up right now. Okay, so on Citi, we did the same expiration. We're down about 2%. We bought the 89 and we sold somewhere close to the 94 strike. So here it's a little tougher to do because we just didn't have as much. There's not as much premium that's in the option contract, but we didn't pay as much for it either. Weren't even close. So if you got the 95 on, you buy that for 40 cents and close it, and you go down to the 92. The 92 is the 31 delta. So you'd be fairly similar to that. So if you got the 95 on, we're going to buy this one. Let's buy the 95. And that would be buy to close, and we'll sell this one. We'll bring in an extra 57 cents. We got that will give ourselves a little bit more upside on the underlying stock to go to this range. Might sell the 93, but I think I like the fact that this is 30 cents more. You're still getting a good amount of change based off of going down to the 92 strike on the Citibank, and that would be the adjustment. JP Morgan, we had the 280-300 on with the August 8th expiration. Okay, so JPM, let's look at that one. August 16th expiration, 280-300. 280 is here. So we're still in the money on that. Stock was at 283.90. Okay. So we did this. That's right. We did this trade a little bit later. We did this at the beginning of the earnings season. This is the first position we put on. 283.90 is where the stock was. Stock is now at 284.40. So we're probably up on this. $8 we put that on for. 280. Sell the 300, but I still would adjust it. Yeah, we're about break even on the trade. We put it on somewhere around $8 at the midpoint. It's now $6.78, but there's no reason why we can't adjust it. August 16th is still the expiration, or August 1st is the expiration, 16 days away. So here you go. So here's how the adjustment would go. You would go in, give yourself some upside. We didn't get the big move to the upside. It would have been wonderful if the stock would have skyrocketed above 300. So we're going to take this position off, sell the 300, and let's go down to somewhere around 30% chance, 243, and we'll buy this one. Or we'll sell that one. 292. So, yeah, maybe we do the that's 75. That's 80 cents difference. Let's do this one. 290, 284. It only gives us 5 points of upside, though. All right, we'll do the 290, 250. I just don't like the half point strike. So now we're bringing in $1.48 net credit. We put this on for around $8. We're going to reduce our risk by $1.48. We're going to give ourselves some upside. We're going to be from 284. Or 280. Okay, so 280 to 292.50. So that's $12.50 is the maximum width of the trade. We put the trade on for $8, and we'll say we got this filled for $150. So that's $650. So we have $650 of risk on, and we have $12.50 worth of upside. We still got a 2-to-1 or a 1-to-1 risk reward, right? We're risking $650 to try to make 12. And you subtract that out at $650. It's basically $6 to make $6. $1 per dollar. It's worth doing the trade. You could just close the position and say that we broke even. I like to do it this way. I like to make the roll. I'm still bullish in the banks, and in particular, a lot of the investment banking stocks like JP Morgan and Goldman Sachs and even Morgan Stanley in that range. All right. Any other questions? Let me see where we're at. Now we got Netflix earnings coming. Should probably do something in that, right? Netflix has started to sell off a little bit. And if you do have any questions or comments, please do put them in the chat box. But let's look. And I mean, I kind of feel guilty if we don't do something in Netflix, because we still got the same scenario where very strong run up, and then we have a little bit of a pullback, actually below the 20-day moving average here. 50-day is still within the range. You could still get a little bit of risk on the pullback if they blow the numbers away. This is the range, 1,340. Last earnings report is what started the parabolic move to the upside last time that we had the earnings. So very, very strong chart going all. Let's put in like 15. Let's go 2,000 days. Like, look at the parabolic move going all the way from these lows right on, and almost bounced exactly off of the 200. As the 50 provided some support, it kind of looks like it has throughout time, but the 200-day has definitely been in play. And then we zoom in here. Let's do this. All right, so let's think about skip strike butterfly at 1,340. They're going to announce on Thursday, the 17th, after the close. So you're going to have 1 day for these to live. So do we want to be bullish, or do we want to sell some premium? Let's look at both of them. Okay, so we either do an open wing in this scenario, NFLX. And I guess, Jake, I didn't really answer your question. I don't see it setting a new high as far as Goldman Sachs is concerned, but I think we covered it immensely. You obviously, if you look at the numbers, you think Goldman Sachs could set a new high today. After everything that they said, how good they did, and they beat the last 4 earnings reports actually in a row. So just everything's been solid. You look at the yield curve, you look at the removal of regulations, I could see the stock, like we just saw it run up to break even and then go back down, and now down 5. And so I do think that it could, I think Goldman Sachs could end up by the end of the day. There's no doubt in my mind that it could. It's down 5 right now, $4.50. Okay. So here's the Netflix trade. Let's look at the 2-day trade option contracts, July 18th. Market's at 63.45, most at the money. So here is, wow. So we got a big expected move, obviously, on $1,000 stock. So 80 points. So up to the upside, that's very feasible. 80 points around 20 delta. We're going to talk about 1350. If we look at the chart, that's right where it's at, isn't it? Come on. There we go. Yeah, that's so the market is saying that it could, that the expected move is within the range of a new high, but it would have to break through the new high to get there at 1350. So if we can get this done for about 10% of the width of the strikes, it would be interesting. But this is feasible that it may reach this number. So if we sell this is 5 points. Bringing a lot up. Let's see if we can go 15 points wide. 1340 is about where the new high is at. We'll buy this. Sell 2 of these. Let's buy this one. It's a 20 delta. 20% chance of it reaching that or going beyond it. 65. 16. I'm going to pay it less than 5. So hit this twice. And now our require. We're at the highs, so 1395. I guess we'll do 95. I don't see any other strikes available. Let's do that. 520. Yeah, we can get that done for decent net credit. Okay, 65 cents. I don't mind that. We are looking at, in this scenario, $1,500, not quite 1,500. Let's see what the max risk is, because we didn't skip the strike fully. So the max risk is, $1,000 minus this 55 cents that we brought in. So you're looking to make 50, or we'll call it 60. That's right there. 60 cents on this trade going into earnings. It's got to break through a new high here at 1340. It's got to go beyond the expected move to the upside and push up beyond a 1 standard deviation move to get the max loss. The max loss on the trade is $1,000. The difference, the skip strike, the strike that we're skipping, that creates the short call spread that pays for the butterfly, creates this $1,000 margin requirement minus the net profit credit brought in of 60 cents. So there's a lot of good things in here. I like this trade. Let me just say that flat out. And we're just doing it off a whim here. But if I look at this, we got $1,000 at risk. The market is here. Now, here's your biggest risk if you do this trade, and it can happen in Netflix. It happened the last time around, is that they announce earnings and the stock opens here. More than a 1 standard deviation move, more than the expected move, and it blows the numbers out of the water. But that just happened at the last earnings report. So do we think it can happen again? Who knows? So the market eventually sold off because the stock has always been overvalued. I mean, as far as if you talk to any of, almost since the beginning of time, Netflix has always been thought of as an overvalued stock as far as price to earnings. But the stock just has been very resilient, and it's recently been a darling of the stock market. So this is what your risk is that it opens this high and you have no opportunity to trade out of it. That is your biggest risk. Now, if it drifts up and by noon we are in this range where we're at the 1320 range, right? 1320, 1340. And now we're looking pretty good, because if the market starts going this direction, this is our profit and loss start. Now, remember, all this time premium has to come out, because at the end of the day, we're done. We're done. Yep, the 17th. Okay, we're done. So this line, profit and loss graph, is going to morph towards the profit and loss graph at expiration. Big difference if it hits the strike at 10 a.m. Eastern time, or if it hits the strike at 1 p.m. Eastern time. Big difference in how this profit and loss graph looks. If it is here at expiration, we could make $15. That would be our upside. We would put it on for a 15-cent net credit, or a 50-cent, well, we said 60 cent, a 60-cent net credit, and we could sell it for a $15 net credit. That's if it landed right on this strike. So I like the dynamic. I like where it is at. The biggest risk, the only thing you really have to be concerned about is that it blows away the numbers and it gaps open more than a one standard deviation move to the upside. So if we look at the trading and we look at the delta on this trade, they're saying the chance of us losing everything is about a 10% chance that the market could close above 1,395. What do you guys think? One of the more interesting trades. Now, this is a totally different trade if it's on Wednesday, right? If they're announcing earnings on Wednesday, I'm not as interested because then you got 2 full days for this underlying to blow through your short strike of your skip strike butterfly. With only 1 day remaining after that earnings event, and you get that volatility crunch, and you get the fact that the stock last earnings made a huge run up, it's now backed off a little bit. There's still risk on the trade, but this is a very interesting trade. Even if you just do a one lot, you're still got a decent net credit of 60 cents to the account with $1,000 worth of risk, and you have the potential that if we land within that sweet spot of our what if calculator here, so ideally what you would want is tomorrow, if the market goes down, we make 60 cents. Everything expires worthless, no worries. If tomorrow we open and the market's half of the expected move, it's trading at like 1320. 80 points is the expected move. We trade somewhere near 1320. We're sitting pretty. Okay, so Anthony likes the Netflix trade. Go ahead and put that out there, and that's fair. And I fail to mention that a lot, that we tape Options Playbook on Wednesday. This company's announcing earnings on Thursday. We're not going to have a show on Thursday. So if you are doing things around earnings, it makes a lot of sense to wait until that day of earnings to put the trade on if you're doing it just based off of earnings. But Anthony is right in that you could put this on, have the stock run up 20 points, and then the risk of it actually hitting that 1,400 strike right here and getting to the max loss, well, there's a little bit higher probability going into that earnings report if that were to happen. So especially on a trade like this, where you have a lot more risk versus the net credit received, right? The risk reward, if you are wrong and the market does make that one standard deviation move to the upside. I really like the setup on the Netflix trade. And it's partly because, once again, it's a $1,400 stock. Well, right now it's a $1,260 stock. Let's hope it's not a $1,400 stock here in the short term. But because it's a $1,260 stock, that adds premium to the price of the option contracts. The fact that it's announcing on a Thursday, you got a 0 DTE option after that earnings announcement. Time decay will be huge in the premium of these option contracts. Implied volatility crunch will be huge. You're trying to get time decay and implied volatility crunch on your side. Now you just need the stock to behave. Interesting trade. Any other thumbs up? Anything else we got out there? Or am I just talking to myself? All right. Well, I definitely went long. Did a lot of the adjustments. I am annoyed by what's going on in the banking sector, but I do see it as a buying opportunity. As a matter of fact, I am going to actually go in and add to my Goldman position in my retirement account. I already own some of it, but the fact that if the stock is going to be down today with what they said around earnings, I do think I will get long a little bit more in the financial space. I do have some fodder sitting on the sidelines recently. So with that said, that's it for this edition of Options Guide TV. I will be back on Friday. We'll see how this Netflix trades works, but this is a real solid setup because of everything that I just mentioned. Thanks for tuning in. See you hopefully inside the Tradier Hub this Friday. And then also, you can watch us on YouTube. You can follow me on X. My handle is @BrianOverby, and you can watch all of these events every Monday, Wednesday, and Friday at 11 a.m. Eastern Time. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.